I'm Simon Edelsten from Goshawk Asset Management, and I'm going to do a quick introduction to our main valuation tool, which we call the ValueModel. Like many equity investors, the first thing that we look at with the company is how much cash flow it's got, how much its cash flow is growing, and compare the cash flow, which is what shareholders end up with the share price that you're asked to pay today to participate in the future of that company. So like most equity investors, we do a discounted cash flow. We look at the cash flows that the company's been producing. We look at how much those cash flows would need to grow in future in order to justify the price we're being asked to pay today. We do the same process across thousands of stocks around the world in different industries, and obviously different industries are slightly different, and that needs to be taken into consideration. But this is the principal way in which we justify to ourselves why we are prepared to pay a certain price for a share today with all the risks involved. Why would we take money out of the bank, buy some shares in a company, and expect to get more back than the cost of those shares in the market that we're paying? Now, although many investors do this, we do it in a rather different way from other people, and there are other valuation approaches we use which we believe are quite unique to Goshawk. Just sticking with the cash flow approach for the moment, the main two differences between our approach to cash flow and other people's approach to cash flow and discounted cash flow valuation are three, really. The first one is, how do you discount those future cash flows? Many people who have been to business school are told that you have to create a discount rate using current interest rates, whatever inflation is, the cost of capital, and something mystical called the equity risk premium. Now, this is all very academic and all very interesting, and we understand what it all means, but it does mean that you would pay more for an equity if interest rates were low, and less for an equity if interest rates were high. Now, we do think that you need to expect more out of a share if inflation is high, because, of course, what we want is for the value of our share that we're buying today to be worth more in real terms in 10 or 15 years' time. There's no point in buying a share if it can't buy you more stuff later on than you've paid for it today. But unfortunately, interest rates, which drive around many people's discount calculations, and inflation have become slightly detached in recent years. You would have noticed in the UK that interest rates are much higher than they were 3 or 4 years ago, and inflation, officially anyway, hasn't moved all that much. So what we're interested in is adjusting future cash flows for inflation, and not just for the equity risk premium and this so-called cost of capital malarkey that has been introduced into capital markets talk really in the last 20 years. So to keep the process really simple, we just say, what do we want out of a share? We want an 8% real return compound forever. That figure 8 has been around for a long time. Actually, the figure is 7. If you make 7% return per annum, ahead of inflation, you will double the purchasing power of your investors' cash within a decade. And as my old boss, Niels Torb, used to say, if that isn't good enough, I don't know what is. So that's our target. Why do we go for 8 rather than 7? Because you need a little margin for error, quite a big margin for error. So if we can achieve 7, that would be great. So we put in the model 8 and we don't change it. The only time we do adjust it is if we're analysing a company which is in an emerging market with very high inflation rates, because then you need to keep an eye on the way in which inflation affects accounts. But that takes a whole lot of quite sophisticated alterations and dampening down of expectations, which we just do for emerging market stocks where very high inflation is around. But for most companies, using an 8% discount rate, which Alex and I have used for the last 15 years now, seems a perfectly good way of doing things. We apply the same discount rate around the world. That's very unusual. So we want the same rate of return, the same real return from a Japanese stock, despite them having negative inflation for most of that period, as we would do from a British share, despite us having quite high inflation. From our point of view, we're investing your money. We're investing it around the world. Why should we want a different rate of return just because local interest rates are different? We don't see it that way. So by applying one discount rate across all countries and all stocks in all sectors, we think that that sets a level playing field for where we allocate the capital and which shares we buy and how we value shares. We value shares on one basis only. The second adjustment we make, which we're very strict about, is that in American companies in particular, they pay a lot of their senior management out of share options. And so we treat those share options as if they have been bought in the market by the company, and therefore the value of the share options they're giving to their senior management, and sometimes all of their staff, should be treated as a cost of doing business. They should be expensed. So we look at, particularly this affects technology companies, we look at the technology companies as if they're having to buy all those shares, give them to their staff instead of pay. They still may get a tax advantage out of it, but we don't think that you just count one of the biggest costs in the business, keeping and hiring and retaining highly talented tech staff, as if it's at no cost, which is how it's accounted. We think that's a ridiculous way of looking at things. But it does mean that we tend to have much lower cash flow figures for technology shares than are commonly used by a number of Wall Street analysts. And that has made us more cautious about what we buy. But it's still meant that over the last 5 years, 8 years, we've owned quite a lot of technology shares, rather less today. But it hasn't stopped us from buying them. It's just meant that we're rather more cautious than other people about buying them. So those are the two principal ways in which our cash flow analysis is different from other people and has led us to a different shape of portfolio from other people. The main area of the value model, though, which is, we're told, very different from any other fund management company of our type, global equity fund management company, which selects stocks around the world, is that we also look for something which you might call intrinsic value, or at least Warren Buffett and Charlie Munger have called it intrinsic value. Even if a company is making no money, it's still worth something. So how do you work out what that company is worth when it's not making any money? Or how do you work out when the share price has fallen too far, when it's had a profit warning, because it has an intrinsic value which will come out in the end? And here we go back, as Buffett and Munger have done, back to the early style of investing back from the 1950s, 1960s, which was in those days value fund management based on the balance sheet. So the good thing about a balance sheet of a company is it doesn't change very much over time. And it gives you some idea about how much it would cost to build that company again if you were starting from scratch. Now, one of the other interesting points about that is that if you've got a company which is very profitable, other people will be trying to build companies which look just like that because they'll want to compete with it. They'll want a bit of its market. So by working out the intrinsic value of a company and comparing it with the market value of the company, you might identify, we often do identify companies which are in very attractive areas, but where the share price is a long way higher than the intrinsic value. And we'll also identify some companies which are in very out of fashion areas, but where the intrinsic value is higher than the current market value. And those two aspects both interest us. The first, obviously, is a warning. If this growth company doesn't achieve the growth that it's promising to make, this is how far the shares might fall. But on the other hand, here's a company that everyone hates, or everyone's ignoring more often, which is probably worth more than the market's saying, and it would only take a little bit of an improvement for the share price to catch up that intrinsic value, perhaps in different circumstances sometime in the future. But we might have to be patient. So Firstly, it tells us about the risks in the more fashionable parts of our portfolio. But secondly, by running our value model across a wide range of stocks around the world on a consistent fashion over time, the value model itself sometimes produces stock ideas for us which might appeal because they're in sectors or themes or parts of the world economy which we think, although they're now out of fashion, might come back of some interest sometime in future. And goodness me, here are some stocks out there which really look very, very cheap on a long-term view and are thoroughly unloved for the moment. So the value model works both as a due diligence tool to make sure that we're not spending too much money on buying any share, but also as an ideas generator. Sometimes we'll find stocks which are surprisingly cheap to us, even in markets which look very expensive, but they just look as if they're trading below what it would cost to build that business again, or what that business would be worth if the management managed to turn it around, if the management managed to get it back to the sort of productivity that one would normally expect in more normal circumstances. Now, the balance sheet side of things is basically the mechanics of it, is that we take what the reported balance sheet statement figures are, but all of these are historic figures. They don't really represent what it would cost to replace the business today. Sometimes you have to adjust those figures up, sometimes you have to adjust them down. For instance, if you took the balance sheet of a car company, you wouldn't build a car company the way in which they were built 20 years ago. And so the plant and property assets of that business may well, although they've been written down, they've been depreciated over the years, they may yet overstate the value of that plant. That plant actually might be a liability more than it's an asset. And so you have to go through each line of the report and accounts, each line of the balance sheet, and think, are these historic figures in the way in which accountants define them? Are they the right figure for the replacement cost of those assets or not? On the other side of that, there's a very large item in most companies' balance sheets these days called goodwill or intellectual property. Intangible assets are often the dominant assets of modern businesses. And again, goodwill, which is the figure that is put in there, doesn't really tend to state at all accurately. It doesn't even intend to state accurately what the intellectual property value or the brand value of a business is. And so we use a proxy here using the historic costs of building the intellectual property in the business, which tends to come through the SG&A line and the R&D line in the income statement of a company. And we say, for this company to build up this brand value, they would need to design lots and lots of products with that design and trial them over the years. So let's just use 5 years of spending money developing brands. Let's use 3 years of spending money developing intellectual property, writing software and only running with the better ones. And in this way, we've built up a feel for how to replace that intangible asset value calculation. We know that our balance sheet revaluation tools are very much finger in the air. But again, Alex and I have been doing them for 15 years. They don't intend to be that accurate. We're not trying to come up with a share price target within 10% either way. What we're interested in is whether the shares are trading a lot higher than their intrinsic value or a lot lower than their intrinsic value. And we do find that the tool has worked very, very well for us. It does fairly persistently tend to say, or has fairly persistently tended to say, that a lot of large Japanese companies are very attractive because they have big market shares. They'd be very difficult to rebuild for the valuations that they have. On the other hand, of course, they tend to have much lower profitability than the equivalent American company. So they don't tend to do so well on the cash flow part of our valuation, but they tend to do much better on the balance sheet, the intrinsic value part of our valuation. But on the other hand, we have also found some out of favour American companies which have traded below asset value, below intrinsic value, and have given us the opportunity to buy shares in a market which other people have felt is wildly expensive. It's amazing how this tool has allowed us to find some stocks even in expensive markets which are out of favour and has led us to buy them at very good times. For instance, when we bought Intel 18 months ago now, when we bought Schlumberger a year ago now, both of them were picked up by this intrinsic value side of our valuation approach. So we put the two together. We keep an eye on all the stocks in our portfolio using the value model. We also keep an eye on a few hundred other stocks around the world which are in themes we want to invest in. The value model, fortunately, is fed by data feeds from outside the firm. For its first cut, we can get a very quick sighting of whether a share might be of interest, might not be of interest. But then we wouldn't actually deal in that share. We wouldn't buy it until we'd done our own due diligence, gone through the reporting accounts, gone through the notes to the reporting accounts, and made sure that the valuation is accurate up to our own standards, and that we haven't missed any data features which are, or accounting quirks, of which there are very many these days, which mean that we need to adjust, particularly the cash flow statement. So that's the due diligence process we go through and the valuation process we go through to check that we're not in shares that are too expensive, that we're looking at shares which are cheap if out of fashion, and hopefully which allow us to build a well-balanced portfolio with growth stocks at one end and intrinsic value stocks at the other end, which can cope with most market conditions. If you need any more information about this, or if you've got any questions, as ever, our website is www.goshawkam.com, and we'll try to answer any questions that you have. And thank you very much for listening. Goodbye.
The content of this video is provided for information purposes only and is not intended to be an offer or solicitation, nor is it intended to be investment advice. The funds run by Goshawk Asset Management may have positions in any of the stocks discussed, but their inclusion in this video should not be taken as a recommendation. Historical performance information is presented by way of example only, and this video may contain forward-looking information that is not purely historical in nature, with no representation made that the performance presented will be achieved and no guarantee that any forecast will come to pass. Reliance upon information in this video is at the sole discretion of the viewer. It is not intended to be relied on in making or refraining from making any specific investments or other decisions. Opinions expressed, whether specifically, in general, or both, on the performance of individual securities and in a wider economic context, represent our view at the time of preparation and are subject to change. We hope that's helpful.